Hey guys, my name is Arjit and welcome to a session with Quant Gnosis Diary. So this is going to be a second video in our investment prequel series, and in the first video we learned about how to manage money so that you can save up for investment. In this video we are going to learn about how to manage the risk and how to understand the risk that are involved in the investments. So basically we are taking literal of our popular media slogan, investment is subject to market risk. We are going to learn about those market risk. So what are market risk? Before understanding that, you understand what is a risk, right? So in our day-to-day life, we don't know what's going to happen tomorrow. So the future that holds before us is uncertain. Nobody knows what's going to happen tomorrow. So we can have common life problems like a health problem or the financial problem suddenly tomorrow, and we don't know that, right? So those risks are there as long as we are alive. So there are common life risk, right? So market risk, when you're talking about a market which deals with the security market. Basically it deals with a stock market, it deals with a commodity market, it may be dealing with the debt market, or it may be dealing with the currency market. So these market could be either virtual or the physical. Making an investment decisions or trading decisions in these market, you will need to understand what are the risks involved in those market. Why will I make a decisions to invest or trade in this market if these market are risky? So the answer to that is nothing in life comes without the risk, right? So even if you're walking out of the home, that also involves risk. So sometimes we just need to take a leap of faith and just go outside the home and enjoy the outside, right? Even though there are risks. Similarly, the reward from the market comes by taking the risk. But the reward could be tricky part unless we don't understand these risks. So for understanding that risk, we'll understand some examples. Okay, so what could be some risk? Let's say, let's forget about market that involves security. It could be a market of your common grocery market, right? Let's say you are buying a potato or onion, or let's say meat in your day-to-day life. Okay, what happens? There is sudden demand because of one day you go to the market and you see prices are really high, and there is increase in demand because it was a festival season at that time, and then prices jacked up because of those things. So because of a festival, an event, uncertainty occurred, and then uncertainty caused the price to go up in your grocery item. Or it could be something, it's a time where the big part of the religions, let's say, not eating meat. There is a month of the year in India, there's some place the people don't eat meat in that month. So which means the demand falling at that time, and which is causing more supply of the meat, and then it's maybe reducing, the price may go down or price may crash in that time. So just based on the simple demand of a product or supply of a product itself, it's causing fluctuations in the price. So if we think that concept in the stock market or the commodity market or currency market, these markets as well, so there are also an inherent risk that are involved. So there could be a sudden supply of certain security or sudden demand of some security that could affect how much the price of that security is moving up or down. So in Hindi there is a saying, right? अगर सर है तो सर दर्द हो सकता है, which means if you have a head you might get a headache. So if you are part of a system, so the system comes with a risk of the system itself. So what are the system of the market? The market is basically involves of trading of security, which is there are some buyers and some sellers, and sometimes the sellers are institutions or the company which is issuing the shares, or there could be a government which is issuing a bond, or it could be just simple people who are already holding those shares or the bonds before, or the commodity before, they just trying to sell it from their holding, right? So those are the participants. So the companies, the buyers and sellers, and the government. So all of this part of the system. Now think about, the system is not just that. The system is much more bigger. The system is also a country. System is the world, because the economy of the world or the country is also involved in how much profit a company is going to make, or how much losses company or business is going to make. All of this dependent on the chain of bigger ecosystem. So let's say there is a pandemic suddenly happened in 2020 March, and the entire world went for shutdown for temporarily, and then a lot of businesses got affected from that. So nobody knew that there's going to be a pandemic, and it suddenly happened. It's just part of the system. It just impact the entire market togetherly. So that is a systematic risk. So as long as you are part of this bigger system, there will be some systematic risk, and which cannot be avoided, and which is not predictable at all. There is also another type of risk that are involved in market, which are unsystematic risk. So these are the risk, these are the factor or the trigger that involves, let's say, one business. So let's say one company went bankrupt because they could not sustain their customer base, or they could not have enough liquidity in their fund so that they could continue to do business. So that one, it's affecting one company, or it could be a sector itself. Let's say there is sudden change in the, something in the industry has changed, and it revolutionized the industry to have a demand of something else rather than it was happening in that. So it could impact the entire sector itself, right? So when it's doing that, part of the system is affected by, let's say, a single business or a sector, the type of business, a selected small group of business that are getting affected by those factors. So those are part of unsystematic risk. So we have heard about some company going bankrupt, right? Reliance Communications. So that company went bankrupt, and then so that's a part of unsystematic risk. So we understood what are the risks, we got a little idea of the systematic risk and unsystematic risk. Now we'll talk about some of the random terms that measures the risk involved in the market. We are not going to go in deep understanding of this parameter for the sake of keeping this session simple enough so that everyone can understand, but I'm going to mention those. So first parameter is alpha. So many of you who have already dealt with, let's say, stock market, or let's say you have bought a mutual fund, you heard about that saying that fund manager generated a good alpha. So alpha basically denotes what? Alpha denotes that how much a stock or a fund is outperforming the benchmark index. So if it was USA, let's say it's a S&P 500, how much is Apple outperforming S&P 500? That comparative value that comes to denoted by alpha. So for India it could be, let's say, a stock, let's say stock of ICICI Bank, how much outperformance it has done compared to the benchmark index of, let's say, Nifty 50. So that could be an example of how much alpha is generated from there. The next one is beta. So beta is basically measures volatility or fluctuations, which means high beta stock is essentially means higher price range of the stock. So the price moves between the higher range in general in that stock. And low beta stocks means the stocks has a lower price range. So when I'm talking about risk, it does not always mean bad. So risk does not always mean bad. So higher volatility also does not mean bad. So especially for those who trades in short term or intraday, for them they will actually want to trade in high beta stocks, or the stocks that have chances of moving bigger than consistent slow movers. So that again it comes as an opportunity to short term trader. Beta can also be negative. So negative beta basically means the stock basically in general moves opposite to the market. So if market is going positive, the stock moves negative. If market is going negative, the stocks move positive. So that correlation is denoted by positive beta or negative beta. Third one is not only just related to risk parameter or the stock market, but it has much more bigger implications and much more usage, I would say. The standard deviation. So standard deviation basically calculate a statistical deviation, how much number can move in a based on the historical data. So it gives you a historical price range and the probability of price to staying inside range based on mathematical or statistical normal distribution theory. So standard deviation can be used to measure the volatility that are involved, that are risk that are involved with the volatility as well. So there are some other terms like Sharpe ratio or R squared you may have heard of. So Sharpe ratio is basically nothing. It's just, let's say you are taking some extra risk and trading in, let's say, a higher beta stock. So for the extra risk, how much extra return you are getting, so that is measured by Sharpe ratio. And R squared is something that basically interpret the stock movement based on the benchmark index. So let's say there is Nifty is moving 1% and the stock is moving 5%. Then for 1%, in that 5%, how much amount it affected the stock's movement. So that is measured by R squared. There is also one more parameter called value at risk. So some of you already have seen this if you are doing analysis fundamentally for certain stock. Value at risk basically measures probability of losing XYZ amount in certain amount of time. Okay, so there could be that let's say there could be a 5% chance you may lose let's say 2% value of this stock in a month. So I would suggest you can go ahead and read up on this parameter. So far what we have learned is basically we understood what are the type of risks are there and how they impact the market and how they are related to the entire system, and how about those risks can be quantified using some of the ratios or parameter of risk management. Now talking about management of the risk, we will go to directly how to manage risk. Why do we need to manage risk? Because let's say you have let's say $100 originally. So if you lose 50% of that directly comes to $50. But if you have a $50 at one point of time, if you want to get back to that previous $100, you will need to make 100% profit to reach that $100. Which means if you are not careful enough to maintaining saving what you already have originally, that $100, and you lose it randomly and make it to 50, it will be much more difficult to reverse that and come to the original position. But your investment or trading decisions. So basically risk management is something that should be planned well before entering an investment or entering a trade. The first one in that method is avoidance. So what does avoidance means? Basically, if you do thorough analysis and research before making decisions of investment and trade, so you can avoid by knowing that this is not the right time to trade or this is not the right time to invest for this security. So when you know that, you will avoid that security. So it's a company, let's say, which does not have good financials, you will avoid investing in that, right? You know that there's a risk of that company going bankrupt. So by avoiding that completely, you are avoiding the risk of investing in that company. A more generic example will be, let's say I'm expecting an event. Let's say there is a United States having elections in the start of the coming November. So in 1 month there are going to be events. So that event. So if I just don't do a fresh investment and wait until the event is over, so in that way also I can avoid that risk involved associated with that event. So which means you can either avoid by researching it, you can avoid trading or investment decisions just before an event, you can avoid that, or you can avoid based on your research. If something does not look good, you just avoid it. So that's one way of managing risk. So because we know it already, it's part of the basic things, we tend to ignore. But you remember that the basic things also sometimes saves us big. So if you know that it's a right moment, it's not a right moment to invest or trade decisions, in that case just avoid it. The second is putting a stop. So what is stop? It's basically a predetermined amount of loss you define beforehand. Let's say when you are making an investment, you know that's a risk involved, right? So but what if you plan for the future in case it goes opposite to your expectation? What if it goes into loss? So it determined you have invested, let's say 10 grand or 10,000 bucks in a stock, or you traded a stock for 10,000 bucks, and you know that if its losses crosses more than 1,000, then you will not hold on to that trade or the investment, and you will liquidate it and take back that remaining 9,000. So in that way you are reducing the risk by putting the stop. Why? Because something when it's falling down, let's say you bought a stock for 10,000 rupees and the stock is falling to 9,000, it can also fall to 5,000 or 2,000, right? So by making a planned stop, a planned measurement of stop, you are securing does not matter whichever side the price goes, you already have a plan, and it will give you so you will not have tension when you are actively inside the investment, because you have a planned stop, right? So if it's a loss of 1,000, you get out and that's it. You accept that was a mistake to invest or trade and then get out. So that is one way of managing a risk. Third one is diversification. So this one is one of the popular way of managing risk, and not only just investment or trading, it could be also applicable to your managing your personal finance. So there is a popular saying, right? Don't put all of your eggs in single basket. So if one is spoiled, then other might get spoiled. Now this is not just, like I mentioned, it's not just market related thing, right? It can be diversification can happen inside the bigger broader sense as well, like in our personal finance. Let's say you have 1 million up, let's say you have 1 million of savings. So you can choose to dump the entire 1 million in a single savings account of a single bank, and tomorrow if something happens in that bank, you lose the entire money. But what if you divided the money and kept it in different 3 banks, and so let's say 300k and 400k you have kept in somewhere, and then let's say one bank with 300k when bankrupt, you still have 700k left. So you're basically spreading and equally distributing your risk in multiple instruments, in multiple banks. You're keeping the money. Or another example could be, let's say you're keeping in different asset class. So you're diversifying your personal finance into different asset class. So let's say you have some gold bought into form of some jewelry, or it could be some land, or real estate. You have bought some land and kept your money parked in there, and then maybe it's with your in a government fund that it is there. It's a provident fund or a mutual fund, whatever fund it is. You kept some money in there. So in different, you are keeping the money in different basket, right? So if there is a problem with one basket and then that one egg is get rotten, then rest of the basket you will still have your money. So you're spreading the risk of spoiling the entire thing at one time. Instead of that, you're just spreading it across multiple instrument. So similarly in market, you can, instead of investing in single stock of single industry, you can spread your investment across multiple industry, multiple businesses, multiple companies, and that way your risk will be spread a little amount in the entire portfolio of your investment or the trading, right? So if something, one investment goes wrong, you still have the 9 investment. Let's say out of 10 investment you have one investment gone wrong, then you still have the 9 investment which is giving you the money. So that's how diversify, manage the risk by spreading the risk across multiple instrument. The fourth one is hedging. So hedging is also again a broader concept compared to the similar to the diversification. So it's hedging is basically like buying an insurance for an unpredictable future. You have done the investment, then you are doing some buying a put option or selling a call options or shorting a future against your investment portfolio. So this way you can do hedging. So this is again not for the beginners. The management, risk management using hedging is not for the beginner. So some of you may not understand at this point while you're starting watching this video, but so you're basically buying an insurance. So just understand that it's like a buying an insurance. If there's something goes wrong, you already have an insurance, and that will protect your capital while doing the investment or the trading. Last one, but not the least one, is something called position size. So position size basically determine how much quantity or how much money you should be investing in a single trade or one investment decisions. Let's say you are going to buy XYZ stock in certain price. So when you are calculating your position size based on your how much capital you have and how much risk you can afford, based on that you decide how many quantity of that XYZ stock you are going to buy. So by deciding the right amount of quantity and the positions, what you do is basically risking how you are limiting how much money that could be lost if something goes wrong in that stock. So by using a proper position size, you are reducing the total amount of risk in that investment decisions or trading decisions. So we learned overall a high level of how to manage the risk. We understood how what are the risks, and there are different ways to reduce and mitigate those risks. In the next part, we are going to talk about the more details about some of these. So we'll more talk about diversification, we'll more talk about how to put stop loss in, especially for short term trader. This is very useful instrument, or for those who are doing in FN or future and option segment, hedging is very good option to manage a risk. Or in overall, all of them who are trading short or long term, position size is one of the another important parameter. So we're going to go more deep idea of these concepts later in later part of the video series, but for today this is it for now. Previous video of money management, right? So we talk about emergency fund. So if you know that there is investment is subjected to certain risks and there, so that's why it's more important you understand the importance of emergency fund. So you need to remember while making the investment decisions or trading decisions, you don't do it with the emergency fund money. So that should be kept separately, and this money entirely comes from only from the savings, not even loan. You do not borrow money to make investment or trading. So I hope that is clear, and with that I'll conclude this sessions. Please hit the like button and subscribe, and take care.